Right now, at this very moment, there is a deadline quietly approaching that most people in the United Kingdom have absolutely no idea exists, and when it passes, it will not come back. There will be no second chance, no appeal, no way to recover what you lost. I am talking about the 5th of March, and if you are watching this video after that date without having taken action, you may have already said goodbye to a tax-free allowance that could have saved you thousands of pounds for the rest of your life. This is not an exaggeration. This is not a headline designed to frighten you into watching. This is a real, legitimate, and genuinely urgent financial deadline that HMRC will not remind you about, your bank will not warn you about, and your employer almost certainly has never mentioned to you. The clock is ticking right now, and the only question is whether you are going to act before it runs out or spend the rest of the year wishing you had. Welcome to UK State Pension with David. I am David, and this channel exists for one reason and one reason only: to make sure that people across the United Kingdom have access to clear, honest, and genuinely useful information about pensions, tax allowances, and retirement planning. No jargon, no complicated language, no information hidden behind a paywall, just straight talking advice that helps real people make better decisions about their money. If you are approaching retirement, if you are already retired, or if you simply want to make sure you are not leaving money on the table that rightfully belongs to you, then you are in exactly the right place. Today we are talking about one of the most important and most overlooked deadlines in the entire UK tax year, the 5th of March, what it means, why it matters, and what you need to do before it is too late. Let us start from the beginning, because to understand why this deadline is so important, you need to understand how the tax-free allowance system works in the United Kingdom. Every single person in the UK has what is called a personal allowance. This is the amount of money you are allowed to earn or receive in a given tax year completely free of income tax. For the current tax year, that allowance stands at £12,570. That means the first £12,570 of your income, whether that comes from your salary, your pension, your savings interest, or other sources, is not taxed at all. Every pound above that threshold is where income tax begins to apply. Now here is where things get interesting, and where the 5th of March becomes so critically important. The UK tax year does not run from January to December like the calendar year. It runs from the 6th of April to the 5th of April the following year, which means the 5th of March is not just any random date. It is one of the last opportunities you have to take action within the current tax year before it closes on the 5th of April. Once that tax year ends, any unused allowances, any missed opportunities, any actions you fail to take are gone permanently. You cannot go back and claim them. You cannot carry most of them forward. They simply disappear. So what specifically can you do before the 5th of March that could save you money? Let us go through this properly, because there are several areas where acting now rather than waiting could make a significant financial difference. The first and most important area is your ISA allowance. Every adult in the United Kingdom is entitled to save up to £20,000 per tax year into an individual savings account, an ISA, completely free of tax. Any interest you earn inside an ISA, any investment growth, any dividends, none of it is subject to income tax or capital gains tax. This is one of the most generous tax-free allowances available to ordinary people in this country. But here is the critical thing you must understand. Your ISA allowance cannot be carried forward. If you do not use your full £20,000 allowance before the 5th of April, that unused portion is gone forever. It does not roll over into the next tax year. It simply vanishes. The 5th of March matters here because if you leave your ISA contribution until the last possible moment, you risk running out of time. Banks and investment platforms can take several days to process transfers and deposits. If you leave it until the 1st or 2nd of April and something goes wrong, a bank transfer delay, a technical error, a system outage, you could miss the deadline entirely. Acting before the 5th of March gives you a comfortable window to make sure your money is safely inside your ISA before the tax year closes. The second area where the March deadline matters is pension contributions. Contributing to your pension before the end of the tax year can be one of the most tax-efficient things you do all year. When you pay money into your pension, the government adds tax relief on top. If you are a basic rate taxpayer, for every 80 pounds you put in, the government adds 20 pounds, effectively giving you a 20% bonus on your pension savings. If you are a higher rate taxpayer, the benefits are even greater. You can claim back up to 40% tax relief through your self-assessment tax return. But again, the deadline matters here. Your annual pension contribution allowance for this tax year is £60,000, or 100% of your earnings, whichever is lower. Contributions above that limit do not attract tax relief and can result in a tax charge. If you have not yet maximized your pension contributions for this tax year, and you have the means to do so, acting before the 5th of March is wise because it gives you and your pension provider time to ensure everything is processed correctly before the tax year ends. The third area to address before the 5th of March is capital gains. If you have investments outside of an ISA, perhaps shares, funds, or property, and those investments have grown in value, you may face a capital gains tax bill when you sell them. However, every person in the UK has an annual capital gains tax allowance. Any gains up to this threshold are completely free of tax. Like the ISA allowance, this cannot be carried forward. If you do not use it, you lose it. If you are sitting on investments that have grown significantly in value, it is worth speaking to a financial advisor before the 5th of March about whether it makes sense to sell some of those investments now to use your current year allowance and then potentially reinvest the proceeds. This strategy, sometimes called BED and ISA, can help you gradually move more of your money into a tax-free environment over time, but it requires careful planning and it requires you to act before the tax year ends. Now let us talk about something that affects a lot of people who are either approaching retirement or who have recently retired. If your income has changed significantly this year, if you have stopped working, reduced your hours, or started drawing your state pension, your tax situation may have changed in a way that creates an opportunity you have not yet taken advantage of. In some cases, people who are now receiving less income than they used to may have unused personal allowance available. That means they could potentially withdraw money from savings or pensions this year at a lower tax rate than they will face in future years when their income increases. Understanding where you stand in relation to your personal allowance before the 5th of March gives you the chance to make smart decisions that could save you real money. If you are not sure where you stand, the HMRC website has online tools that can help you understand your current tax position, and it is worth spending 30 minutes working through your numbers before the deadline arrives. There is one more thing that deserves to be said clearly and honestly. A lot of people reading or watching financial content like this assume that these opportunities are only for wealthy people, for those with large investment portfolios and complicated tax affairs. That is simply not true. The ISA allowance, the pension contribution relief, the capital gains allowance, these are available to every single person in the United Kingdom, regardless of how much money they have. Even if you can only afford to put a few £100 into an ISA before the 5th of April, you are still protecting that money from future taxation. Every pound you shelter inside a tax-free account today is a pound that will grow without being eroded by tax tomorrow. That matters enormously over 10, 20, or 30 years of saving and investment. The people who build real financial security over the course of their lives are not necessarily the people who earn the most. They are the people who make consistent, informed decisions about using the allowances and opportunities that are available to them. They act before deadlines. They do not put things off. They take 30 minutes to understand their position, and then they take action. You now know about the 5th of March. You know what is at stake. You know what you can do. The only thing left is to decide whether you are going to take action before this deadline passes or whether you are going to let it slip by and spend the next tax year knowing you missed an opportunity that will not come back. Thank you so much for watching today. This has been UK State Pension with David, and if this video has helped you understand something important about your finances that you did not know before, please take a moment to share it with someone you care about, a friend, a family member, a colleague who is approaching retirement, because this information can make a real difference to real people, and the more we share it, the more people we help. If you found this valuable, please give this video a like and subscribe to UK State Pension with David so you never miss an update. I publish new videos regularly covering everything you need to know about pensions, retirement planning, and making the most of what you have worked so hard to earn. Hit the notification bell so YouTube lets you know the moment something new goes live. I am David, and I will see you in the next one.